Let me just first begin by introducing our guest speaker here. I think a few people here might already know who I am. Charles, Senior Specialist Valuation and Investment Advisor with RICS, member of RICS. He's a chartered surveyor as well, and a regular speaker at on the topic of valuation for RICS. He's written various articles and produced various insights for the RICS Property Journal and Journal for Building Surveying, Appraisal and Valuation. Also author of RICS Insight paper entitled Valuation of Flexible Workspace. Acted in addition as surveyor advocate and expert witness in the Valuation Tribunal and Upper Tribunal Lands Chamber. Previous to working with RICS, Charles has been a technical and policy advisor at the Valuations Office and a surveyor involved in mixed-use development and investment at GL Hearn, and is a graduate from Nottingham Trent University. Welcome, Charles. Just very quickly, hi, Charles.
Sorry, it took me a while to find the mute button there. First person to do it.
Thank you, Charles. And then just very quickly, as Sonia has mentioned, I'm an academic at UCEM, program leader for the MSc Real Estate program. I am a bit of an unusual character in the sense that while I have 12 years of academic experience behind me, prior to that, I worked for over 15 years, 17 years, it's noted here, in the real estate industry, both in Ireland initially. I qualified as a surveyor way back in '94 in Dublin with the Society of Chartered Surveyors Ireland, the sister body of the RICS. I then moved over to the UK in 2002, working for various organisations such as JLL and CBRE, other firms that we don't, that no longer exist, nothing to do with me, but no longer exist. They were subsumed into large organizations, Nelson Bakewell and Drivers Jonas. They were subsumed into CBRE and Deloitte. You can see some of the work and the clients I've been with are mentioned here. And as Sonia has mentioned, I'm currently proud to be geographical seat holder for the UK and Ireland on RSS Governing Council. I do a little bit of other work in France at the moment with ESPI, the French university, do a little bit of teaching with them. Lovely to be connected with that organization. I'm also an APC chair stroke assessor for both SCSI and RICS. And funny enough, this morning I've just done 2 interviews online with the SCSI. And then just finally, I'm an Inspire Ambassador. What is that? That is basically getting involved in outreach activities with schools and such like, basically to invest in next generation, trying to encourage more into our amazing industry. So that's a little bit about both of us. When we think of discounted cash flows and the challenges of making it mainstream, we have seen traditionally there's the use of term and reversion and hardcore methods of valuation to value commercial property. But there recently, there's a growing interest in the use of discounted cash flows that is becoming more widespread in the marketplace. I've listed here kind of my thoughts in terms of from my own research and focus on the use of DCF. I'm also, I should add, as a program leader for the MSc, I'm also the module leader for the investment module. I did my MSc in investment originally with UCM back in the day. So I'm a specialist on investment. And so this is part of my day-to-day work, teaching with DCF. So here are some of the suggested barriers, perhaps, to the wider acceptance of DCF. Fear of change. Valuers are rather used to using the term and reversion and hardcore methods of valuation. Inconsistency of use. I was really surprised. We have another guest speaker in a couple of weeks' time who produced a paper on hurdle rates, which is a variable. The hurdle rate is a variable within the investment worth method or model when you're using DCF. And I was really taken aback when I attended that presentation back in 2017, just at the sort of questioning, and it was apparent from the audience that different people are doing different things in the way they use DCF. So the inconsistency of use, how different people are say constructing a hurdle rate, let's say for an investment appraisal, or how they're taking an approach on other variable adjustments. So there is that uncomfortable uneasiness about inconsistency in the marketplace, then lack of transparency on risk, how risk is being accounted for explicitly, implicitly, but even how we disaggregate elements of risk, systematic, specific risk. There's that levels of sophistication in terms of how we are addressing risk in our calculations. So that is an issue that needs to be further considered. Future rental growth not explicitly factored in. A DCF model differs from traditional methods as it adopts more explicit assumptions in its approach to the calculation of future growth, rental growth, and that is how do we actually do that? There's limited information, arguably, in terms of not an industry-wide accepted database that people can use to establish what necessarily the rental growth rate should be. So there's some concerns about that. Perhaps the market needs to develop further in that sense to help DCF be more accepted. Analytical tools are two basic. Stress testing techniques have been too simplistic in the past, or maybe not adopted at all. The stress testing, the testing of the variables. What if certain variables shift? There are, in my mind, 5 key variables that are always ones to focus in on in the DCF model. So what is the implication of any of those changing over the 10-year, say, if we assume a 10-year holding period? So that is important. That but again, not many valuers necessarily might embrace that or be aware of the use of stress testing techniques. In confusion between investment value or investment worth and market value, those are two clearly defined bases of valuation. And it's how we use DCF in both. Again, we'll look at that in a little bit more detail next week. I have the guest speaker there talking about market practices as a valuer. And then lack of supporting data, which I've kind of touched on in terms of rental growth, but also other variables like yields, yield growth. How can we justify our position in regard to the yield assumptions we have in those in our key variables? Charles, I'm talking a lot here. Have you any particular thoughts in terms of the 7 points listed here?
Just a few, and to speak from the top to say that luckily, it's not just me at RICS that I work with an expert working group and a lead author, Neil Crosby, on the discounted cash flow and valuation practice information, a well-renowned author on this subject. We also spoke to hundreds of people in terms of gathering the research and consultation feedback from what we did. So when I'm expressing my views, I'll generally be referring back to that evidence. But if I reference something from RICS, I'll say so. I think it's recognised that there are some challenges around DCF adoption in the market, certainly. I think those in some ways reflect the overall heterogeneous nature of the global property market, and the fact that you should adopt different methods, models, and approaches depending on the asset type and the market that one is involved in. So that's one of the challenges in there. You mentioned that there isn't the same available data, certainly in a UK perspective, around market growth and discount rates as you might find around yields. And people share yield sheets, people do research which refers to yield data, but in some ways, that's the role of the valuer, is to provide that additional expertise and analysis. You wouldn't take the result of or you wouldn't take a number off a yield sheet and apply that into a valuation in the same way you wouldn't do that for discounted cash flows. So it's true that there is in some ways the need for the development of data, and that will come in time with increased adoption of different and more analytical approaches suitable for the markets. But definitely we're seeing wider adoption in some circumstances, and certainly as you put there, there's a history of using discounted cash flow valuation for performance analysis, investment valuation, investment worth calculations in any case, both by RICS valuers and people working across the industry. So really the challenge that we've found is using it or adopting it for market value calculations and across more mainstream markets than it might traditionally have been used for. So that's the challenge that we've wrestled with through our research.
Okay, thank you, Charles. Just in regard to latest research, can you, with this slide, talk us through some of the points that are being raised here and the work you've done more recently with RICS?
I can indeed. What I should say, first of all, is that IVS kindly published their new standards that will be coming in from the end of January, 31st of January 2025. They'll be effective. So just some of the references on these will change. These are the current IVS standards that I'm referring to, but the references will change over time. Luckily, in the standards, they haven't changed a lot of the content related to discounted cash flow. So all of that remains valid, but just to be aware that new IVS have come in. And basically, it's useful to look at that international valuation standards definition, which we adopt into our global Red Book RICS valuation standards, noting that the discount, what a discounted cash flow effectively is the sum of the present day values for the individual periods representing an estimate of the capital value, and that the discount rate in the discounted cash flow model is based on broadly the time cost of money and the risks and rewards of the income stream in question, which sounds simple in its directive, but as we'll come on to talk to, understanding that risk and that time cost of money is where the challenge lies. As the slide references, there was an independent review undertaken of valuation, which was instigated by RICS. And what that looked at was valuers being, where appropriate, more analytical, more explicit in their assumptions and valuation methods moving forward. And the valuation review was really focused on the UK market principally and certain investment asset classes. So just to make the point that many RICS members, the majority of our valuer members will be undertaking residential mortgage valuations or valuations where discounted cash flow might not be the recommended method or approach. I mean, it's up to them in terms of choosing that method, but just to note that the valuation review was principally about investment valuation. There was an aspiration within that for DCF to one day be the principal approach that's used in, or the principal method that's used in valuation. Further to all of the feedback and the consultation that we undertook, I think people were very much against that being a drop dead date of from 1st of January 2025, everyone must use DCF. And of course, it must be reflective of the different markets. So how can we encourage that aspiration? Well, hopefully we've done it through educational resources that we've got on our website, the practice information that we've talked about today as well. We're currently developing our global Red Book standards this year to incorporate further details around valuation approaches, methods, models. And all of this is leading towards the encouragement of, overall, it's about being more analytical and more explicit in assumptions and approaches, but where methods such as discounted cash flow can help with that, then certainly we're encouraging its adoption.
And we thank you, Charles. We have a useful link down there for anybody who wants to drill down a little bit more into the reports that were done in 2021 and 2023 in terms of RSS updates on DCF. Key findings then. I kind of feel, Charles, if you want to maybe take us through the key findings of the latest paper, that would be really helpful. I do see there's an observation. Bill, can you put the link in the chat, please? Bill, I'll send it to you later if that's okay. I do have your contact details to get the link for you. So thank you, Bill. So yeah, Charles, could you talk us through the key findings here as they're listed?
With the risk of labouring the point on this one, that it was noted again that there's traditional use of DCF to calculate investment worth. In some ways, the market and the people we engaged with were relatively comfortable with that, and the practice information keeps that in a separate section to cover that point. But the real critical issue in some ways was how we can move towards using discounted cash flow for market value calculations. And of course, the big difference between a market value calculation and investment worth is market value is a hypothetical consideration of a willing buyer and a willing seller. It's more objective, it's more stand back than investment value, which in some ways you're going to have the IRR scenarios for, the growth expectations for, because they relate to the investor or investment in question. So it's easier to find those inputs for an investment worth calculation because they derive from the investor themselves, whereas market value, you can take inputs from, you can take suggestions, evidence from the investor, but you've got to test those against the market. You've got to make those objective. There's benchmarking. You've referred to data analysis as well that can be undertaken with that, but that's really the challenge to bring it into market value, and I should reference fair value as well in terms of financial reporting.
There is the point there, transition of to use of DCF with software. Are you able to elaborate a little bit further about that point?
We spoke to users of DCF valuation software, everything from bespoke Excel or other spreadsheet built models to standalone software products. And in some ways, and it relates to the UK market or markets that have traditionally used the approaches that you set out earlier, David. It's valuation software tools. It can be challenging to transition from implicit approaches to growth explicit approaches. There are certainly products and that are available to do that, and you can develop models that do that, bespoke models that undertake that in itself. But it is a challenge. And part of the way we dealt with that within the discounted cash flow practice information was to talk in explicit terms really about the relationship between the traditional methods and the discounted cash flow method. Ultimately, expectations of growth are built into when someone purchases a property. Presumably, they're reflecting some of that within their decision making. So comparable evidence by its nature should reflect growth, and where you're able to essentially rearrange the formula from those comparable transactions from the income information as it is in an implicit way, you should then be able to understand how to generate the growth figures from that. So within the appendix of the practice information, it goes through that relationship between implicit and explicit valuation methods, and it's one way of sort of resolving the issue. And another way that we spoke to with stakeholders in the market is to not be afraid to use multiple methods and models in order to provide advice. So
to be able to, for that transparency, to have, well, here's the traditional way and here's how the DCF, and look how they sit beside each other through the software packages. So I think that's really interesting discussion and development that's coming. There is then the final point under key findings, geographical variations in usage. Could you tell us a little bit about what variations you've seen out there?
Yes, I'll probably pick the wrong examples here, but there are markets that came up in our research of parts of Oceania, Australia, Sweden, parts of America, where it was perfectly comfortable to use discounted cash flow in order to derive market value or fair value, and that was the approach that was used within that market, and therefore the development of data was at a mature stage where the benchmarking that we referenced and the availability of data supported the use of the method more widely. And then there were markets, and the UK was certainly one of them, where the so-called traditional valuation methods have been used more predominantly. So in developing a global practice information, we reflected upon different adoption in different markets and people at different stages. And I think there's certainly learning to be had across the different markets globally as to how to move forward in being more analytical in valuation.
Yeah, thank you for that, Charles. There is a section here, frequently asked questions, which I've taken directly from the RICS website. The RICS have developed their own transition hub and did set up some training. Nick French kindly produced a series of 3 um, sessions, recorded sessions. It is a subscription-based training piece. I've managed to attend some of the training. I've yet to complete it, just to listen to Nick and his thoughts. He is one of those academics who has been heavily involved in DCF for many years, so it's fascinating to hear his thoughts there. But I need to finish the listening to the rest of the training there. But I would encourage people to, if they're interested, to subscribe and maybe do that. Training course is quite a useful way of upskilling on the use of DCF, and it does look at the differences between investment worth and market value. So really interesting. There are some questions here. Is RSS mandating the use of DCF in valuation? Question mark. If you click on these 4 bullet points on the website, it will give you the answer. But no, I think is the answer there. Very simply, there was. Under the Pereira Gray report, a bit of a stir that there was a sense that that DCF was to replace the traditional, whereas in fact that wasn't the intention. The intention is that DCF is to be encouraged to sit alongside other methods such as term and reversion. So it's not a case that it's RSS is mandating that. Had you any further observation on that question, Charles?
Just to say, we don't mandate any type of method or model because the nature of assets and purposes of valuation globally is of course so broad, and you'd want to suit the valuation method and model to the circumstances that are being undertaken. That's not to say that people can just say, well, I've always used this method, so I'll continue to, or this was the only method available, or the only method I knew about. It is for the valuer to understand their market and what's relevant to it. But we're not mandating any model or method overall, no.
Yeah, and as you say, the heterogeneity of property, you have to make that judgment as a valuer as to what is the appropriate method to use. But certainly DCF can be used in many cases alongside the traditional to cross-check.